Hello, welcome back to AP Macroeconomics with your favorite teacher, me, Mr. Fritz. Today we're going to talk about the relationship between interest rates and financial capital flow and how that affects the foreign exchange market. First, let's talk about interest rates and financial capital flows. Remember, financial capital is always going to flow toward the country with the highest real interest rate. Financial capital is just money sitting in a bank that can be lent out. So in this example that I got right here, currently the US has a 6% real interest rate, while Japan has a 4% real interest rate. That's going to cause Japanese investors to want to bring their money into the United States. So what will happen here? As they pull their money out of financial assets in banks and in Japan, there's going to be a capital outflow. Financial capital is going to be leaving the country in Japan, and that's going to cause an increase in their real interest rate. So let's just say that it's going from 4% to 5%. At the same time, as they pull their money out of the bank and they're experiencing financial capital outflow for the United States, that would be seen as financial capital inflow. As Japanese investors arrive with their money, they put it into financial assets in the US, like the bank or bonds, and that drives down the real interest rate. Because of the relationship between the real interest rate and financial capital flows, if there is a difference in the real interest rate between two countries that trade openly, then we'll see them start to move towards each other as financial capital outflow leaves the country with the lower real interest rate and goes in and causes financial capital inflow in the country with the higher real interest rate. At the same time, now that these Japanese investors are bringing their money into the United States, they're first going to have to buy US dollars because our banks don't want Japanese yen because they can't. If I show up at the bank to make a withdrawal and they give me yen, I'm going to be like, what am I supposed to do with this? I live in the US. So when that happens, these Japanese investors are going to be buying US dollars, which makes the US dollar appreciate, and that's going to make the Japanese yen depreciate as they are selling yen to buy the dollars. So keep that in mind. Higher real interest rate, that's where the capital is going to flow. And because of that, when you have a higher real interest rate in one country, that currency is going to appreciate. And then for the country with the lower real interest rate, that currency will depreciate. That was a quick video today. We'll talk next time when I teach you something different. We're running out of time. It's almost time for the AP test. Goodbye.